This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. In case you're new, on the weekend we like to come back and re-examine the base case hypothesis that this channel has held practically since its inception, and we like to check to see if things are largely speaking still going according to plan. So as ever, we're going to run through this thing from the top down and we're going to do a then versus now and see how this thing is progressing. So without further ado, let's get into this. The base case for the stocks was that at the lows we were too bearish, we would have a blow off top to all-time highs, and then we would come tumbling down in a global bear market and recession, and that for reasons you're going to see a bit later on, this bear market and recession, when it eventually takes hold, would have a deflationary component to it for the third time in US history. So that was then, and this is now. I am making the case we have completed 3 blow-off top angles. We have had my trend change and top call reversal signals, which are the third angle violation, the second angle violation, and then a failed daily cycle. This tells me that on a balance of probabilities, whilst I am expecting a short-term bounce here in the not too distant future, the expectation is now that we will not be seeing new all-time highs for the stock market. Of course, as always, I am more than happy to be proven wrong by the market, but as it stands right now, since we had those 3 top call signals of mine, the base case is that this really was the top for the stock market, and the best we can hope for here is a bounce to a lower high, in which case we'll be looking to let ourselves out of any remaining positions, any short-term trades that are upcoming out of the coming daily cycle low, which we'll show you at the end as always, and we'll be looking to flip short on the highest probability short setup should it occur. Now, as always, as we play this counter trend bounce that's upcoming in the not too distant future, if for some reason this thing is going to invalidate my top call setup, if it's going to push to new highs, then we have a good track record of staying on trend for that. But as it stands, we are operating with the assumption that any bounce here will only resolve to a lower high before then rolling over once more. For Bitcoin, back then, the base case hypothesis was that we would have a left translated cycle. This idea of mine was actually pretty close to coming to fruition. We publicly got in at the lows, we managed to call the all-time high pre-halving, we managed to stay on trend all the way up till this neighborhood, and then what we were looking for was one final push to new all-time highs before November, qualifying this as left translated. However, what we got was a hard invalidation as we then proceeded to spend a bunch of time consolidating instead of breaking out to a new final top, and then the breakout to new highs occurred much later in life. So we got a hard invalidation on the left translated idea, and thus when the market speaks, we have to listen. So that was then, and now we are working with a new base case hypothesis for Bitcoin, which is that this cycle is never going to be any different. The people that were telling me the whole time, Camel, it's never different, it's going to do what it always does, it seems like I now agree with those. I think they were probably right all along, and again, I think the left translated idea was a good idea, but it just didn't come to fruition. So as of right now, we are operating with the assumption that we are going to continue to do Bitcoin things. We are going to continue to find another weekly cycle low and then look for a double. Now, fast forward to today, and whilst a lot of people seemingly want to discount this idea, I am still making the case that we are absent of a true weekly cycle low ever being confirmed. Whilst this thing is taking slightly longer than expected, I think the original arrow was here. You can see that this is the original yellow squiggle. And I am still making the case that all we have to do is just shunt this thing over ever so slightly, and that we're actually going to get this from here. So not too dissimilar. I do understand a lot of people have a problem with this, and that's fine. If you want to sell your stack and go short, by all means, okay? This is just my idea, my opinion, and it could easily be wrong. But for me, I continue to make the case that we are absent of a confirmed weekly cycle. We never ever got a trendline breakout to confirm the weekly cycle. We also never got a DSS Brexit cross on the weekly time frame. If I go in here, okay, you can see just starting to cross right now. Okay, so for me, that tells me that I was correct in my stance, that we never did see a true confirmed weekly cycle, but we are about to get one here. And thus, I still maintain that in the best case scenario, Bitcoin has new all-time highs left in it. Again, I understand this is absolutely not a popular opinion, and many people want to bet against this. And again, that's absolutely fine. Feel free to bet against this. But this is still my base case until proven otherwise. I believe a trendline break will come soon to confirm this is the real weekly cycle swing. I also believe that Brexit cross is going to confirm that as well. And then it is a case of seeing if we can get new all-time highs for Bitcoin. We will, of course, be open to seeing a lower high and a rollover, and if we get that, then at this stage, we will be exiting the market, taking our chips off the table and saying, okay, this idea was wrong as well. But as it stands, I am sitting here every day nearly and saying, I think we've got a chance. So until proven otherwise, this is what we are working with for Bitcoin currently. And I do think one last point that is worth making here is even though the stock market has undergone a ginormous spill, relatively speaking, okay, we are currently looking more and more bullish by the day. This chart, for people with trained eyes, is quietly improving. And note that we are, again, trading all the way back at the exact same level we were back at the end of February. So for me, this is another piece of evidence to suggest that it is indeed premature to go calling the top here and trying to invalidate the weekly cycle just yet. As I said earlier on, if this bear market is for real and the recession is coming, then I expect to see a deflationary component. And the reason I say that is because of a simple rule pertaining to the M2 rate of change. Anything you do to the M2 rate of change shows up in the CPI with a lag. We've got an updated chart here, and I've been making the case that because the snap back in M2 was so violent to the upside during the C19 era, when it comes back the other direction, it will yield a deflationary component. So that is why I continue to expect a deflationary component later on in life. Fast forward to today, and anyone that has been following the channel knows there is really no more arguments to say that we're going to see a resumption of inflation. Everyone that was talking about tariffs being inflationary, again, has been proven wrong, and we continue to operate under market conditions that are very disinflationary at this moment in time. I expect this to continue to move to the downside, as I said, and then I think what we're going to see ultimately is a short period of asset price deflation. Probably no more than 1 to 3 months would be my guess, but we'll deal with that as it comes. So this whole component, again, I think we can tick this off and say things are still going according to plan as far as I'm concerned. We've been seeing this kind of thing confirmed in the CPI and the PPI data in the last couple of weeks. PPI even coming in deflationary month over month. And so again, we're going to tick that one off as well. Of course, if we're going to have a recession, then it's only reasonable to expect labour market deterioration. And that brings us on to the next part of this hypothesis. We know that the unemployment rate continues to tick up. We've been tracking things like U6, which is the 6-month moving average of the unemployment rate, starting to curl up just like it does prior to all explosions and accelerative periods to the upside, which are of course synonymous with recessions. So unless this changes, then it only seems reasonable to me to expect it to continue. And if it's going to continue, then it tells me to be open to a recession probably no later than the second half of this year. And that, of course, is assuming we're not already in one. We continue to track the Sahm recession rule, which again is showing similar symptoms, right? We've got this lead-in phase potentially before acceleration. And you'll note if you look back at the prior instances, that's what we tend to get, a lead-in phase and acceleration that coincides with a recession. Now, invalidation for this would be a new lower low. If we zoom in right here, you can see that we are so far making higher highs and higher lows. So I would think if we can make a new lower low on the Sahm recession rule, we can breathe a sigh of relief here, at least momentarily. But so far, it looks an awful lot to me like all of the prior lead-in phases before acceleration that are, of course, synonymous with recession. So I think it's premature to breathe a sigh of relief here, but of course we are cheering on a new lower low in the Sahm recession rule. We've been repeatedly pointing at things like the temporary help services, showing a recessionary look as well, as is the hiring rate, as you can see right here at the hard right edge. And whilst we think GDP is going to continue to throw curveballs as a result of panic buying before the tariffs hit, I do think by the time we get to the latter half of this year, we are going to start to really see this recession take hold. There is, of course, hope in the middle as GDP pops up. GDP is expected to pop up because people would have been rushing to buy things before the tariffs hit. So I actually think the next print is going to show that. I think the next print is going to be significantly above this. And that may well provide the final piece of relief that the markets are going to see before then we get to the following quarter's readout. And I think GDP is going to start to really roll over. And then I think it's going to be pretty obvious to everyone that this recession is now unavoidable. But again, I think that gives us a little bit of a lull period in the middle of the year where things cannot look so bad. And then, as I said, I think by the time we get to the latter half of this year, the recession is going to really come home to roost, so to speak. I continue to make the case that a lot of the reason for this is we have got overly restrictive Fed policy. When we've got inflation coming down as fast as it is, and we've got the labour market slowly but surely deteriorating, I think Fed policy is overly restrictive. And I also think they are being deliberately slow and late to react. I believe they are doing this because they want to engineer a hard landing so that they can ultimately roll out the CBDCs. I know a lot of people don't like that as an argument either. And if you want to go on the side of Fed incompetence and think you're smarter than the Fed, then by all means, you're welcome to that opinion as well. But so far, everything is largely speaking going according to plan, right? We have the stock market completing a blow off top. We have Bitcoin about to find a weekly cycle low and then reveal whether or not it has new highs left in it. We have inflation continuing to come down as a result of the snapback in M2. We continue to have labour market deterioration with lead-in phases across the board prior to that accelerative period synonymous with recessions. And we've got the perfect storm of overly restrictive policy setting us up to exacerbate the downside move that ultimately results in panic cutting. The writing has also been on the wall in many places if you've known where to look. Chicago PMI, for example, has been sub 50, again showing another recessionary look. But remember, the NBER that are responsible for going back and declaring recessions usually only do so after the fact. In the case of 2008, they were a full 12 months late before going back and declaring the recession started 12 months prior. And I suspect that's what we're going to see. I think when the NBER goes back and paints the recessionary bars, they're probably going to start somewhere in this neighborhood. So time will tell if we're right about that. We also continue to track the high yield credit spreads. Now, breakouts in the high yield spreads are synonymous with financially stressed conditions. We have long been pointing at the fact that we had compression down here. Remember, historic compression precedes historic expansion. And so far, it looks an awful lot to me like we have got the making of a true breakout here. Now, if you're a bull, if you believe there are more highs left in the stock market, you need to see this thing roll over and come back down below the breakout line. This needs to manifest as a fake breakout if you are bullish on stocks making new highs. Otherwise, this breakout has the potential to morph into something more like this, which again is synonymous with recessions and financially stressed conditions. If this breakout continues to push to the upside and doesn't reverse immediately from here, we will be confirming that the breakdown and the trend change in the stock market is for real. And if we briefly go back to the M2 rate of change here, during the C19 era, everybody knows that we had this enormous round of printing. And this enormous round of printing created a have and a have-not economy. Roughly half of the economy is walking around richer than ever. If you were an asset holder and you knew how to position for this, if you were in position before this happened, then you are richer than ever. Okay, but the other half of the economy is poorer than ever. They are struggling to pay bills and they are living paycheck to paycheck. And we can see this under the hood because remember, it's the consumer that drives the business cycle. If the consumer is poorer than ever and living paycheck to paycheck, they do not have enough money to continue to stimulate the economy. And this is what I believe is going to ultimately resolve in that recession in the later part of this year. And some things that we continue to track are things like mortgage defaults, okay? Because we've now got mortgage default rates exceeding the level that we had during the GFC. We've also got auto loan delinquencies approaching rates not seen since the GFC. We've got delinquency rates for credit cards and commercial loans starting to show recessionary looks. And even the delinquency rate on credit card loans for banks outside of the top 100 is now higher than it was during the great financial crisis. This right here perfectly encapsulates the have and the have-not economy. It's very, very easy for asset holders, Bitcoiners, gold bugs, et al. To forget that over half the economy is actually living like this, okay? And remember, it is the real economy that drives the business cycle. It is these types of consumers that are responsible for keeping things ticking over. And thus, if this is going to continue in the way that it is going, and I believe it will, this is ultimately going to show up in the latter half of the year as large negative back-to-back quarters of GDP growth, which of course is the textbook definition of a recession. The last thing I like to point out and monitor, and that makes up the base case hypothesis of this channel, is that we get accelerating yield spreads during times of confirmed bear market and recession. Many investors get this thing wrong, okay? When it inverts, they scream recession. When it reverts, they scream recession. But it's actually acceleration that is synonymous with entering a true bear market and a top coming in. And if we don't have acceleration, we tend not to see a true top come in. But when we go over to the 10-2 yield spread and start to look at the hard right edge on the weekly time frame, this is starting to look like higher highs and higher lows on the weekly time frame. This is starting to look an awful lot to me like the recession is already here and that this top call in the stock market is likely to be correct, that only a lower high at best can come out of here, and then we're going to continue to see new lows set. I really hope I'm wrong about this. As I said before, we're about to get long and play the counter trend bounce here, and I really hope we can stay long all the way to new all-time highs. If there's any hope of that happening at all, then we would expect to see this yield spread turn around completely. Okay, doesn't have to invert, but we would at least expect it to come back down here and chop around for a while. With every week, we say we need to be careful about seeing acceleration here, and with every week, we seem to be slowly but surely ticking up in a near vertical manner, starting to look an awful lot to me like one of these sweeps that was synonymous with having already seen the top come in. And again, it's another piece of evidence that suggests going flat right here on the third angle violation was indeed the correct call. We do have a saving grace here when we go to the 10-year 3-month yield spread, which is a much sharper historical signal. Now, if we zoom in here and get a look, you can see that this thing is not showing anywhere near the type of accelerative look that we saw during the C19 sweep or during the prior global financial crisis and the dot-com bubble burst. So there is one saving grace here in that if the 10-year 3-month yield spread can continue to chop sideways, okay, and not squeeze heavily to the upside, then we might be able to use this as a leading indicator to suggest that the 10-2 yield curve is soon to reverse and chop around in a range. And if all of that is true, then there just might be a hope here to see new highs for the bulls. But as you can see, based on everything I've presented so far, it seems only reasonable to me that until proven otherwise, a lower high is expected in the stock market, followed by new lows. And it seems only reasonable to me that unless something changes in the yield spreads, okay, they're going to continue to squeeze to the upside, which of course will confirm that the top call was correct in the stock market. And of course, we can also see this here in the high yield credit spreads. So again, if this thing is going to turn around and come back below the breakout level, fine. We might have a shot at new highs and Camel will be open to staying long and strong for longer. But if this thing is going to continue to squeeze to the upside, as well as the yield spreads continuing to accelerate on the weekly time frame, then we'll be able to look back at this chart right here with hindsight and say, yep, that makes perfect sense. So for the last part here, I like to point at some charts and look for some short-term trading opportunities. You'll see me call these trades out ahead of time on this channel, and you'll see me take these trades in real time with public invalidation levels. If you're a level 3 member, of course, as always, you'll be notified in real time. The base case for the short-term opportunity here is still that we are working on a cycle low sometime early May, and then we will get a breakout. I expect to be long out of that cycle low with the stop below wherever it forms, and then it will be a case of expecting a lower high and hoping we get higher highs. So I do think there's a nice opportunity here soon to play a counter trend bounce for the stock market. But out of that low, once the cycle has bottomed, I do think we're going to have somewhat of a difficult time navigating what comes thereafter. Gold continues to pay the Camel Crew. We are somewhat expecting a decline into a weekly cycle low now, although parabolic blow off tops like this can continue to be parabolic for a lot longer than most people realize. The level 3 members continue to benefit from the mining ETFs and individual mining stocks, so happy days there, can't really lose. And for me, any pullbacks really are just for buying and adding here. I'm not one of these people that is trying to call an ultimate top here for gold. I know a lot of people are going to continue to do that, but the base case on this channel is that gold is going to continue to rip higher for a lot longer, although some shakeouts and pullbacks along the way are of course expected as per any bull market activity. And for Bitcoin, we kind of already touched on this earlier, but I think what we've got here is some kind of rollover into that daily and weekly cycle. I then think it's going to be party time for Bitcoin, and we'll be open and on guard in case this thing forms a lower high and rolls over, which of course is what the stock market is expected to do. But unlike the stock market, Bitcoin has not fired any signals to me that suggests that's what comes next. What I think is most likely for Bitcoin here is that it's going to find that cycle low and then rip to new highs. And once again, short-term trading opportunities, I think we're going to be long something akin to this out of this cycle low, and we're going to be targeting 150k plus. I know it's not a popular idea, but by all means, okay, trade against me. Entirely your prerogative. And again, if you're a level 3 member, we'll be looking to capture this Bitcoin breakout out of the cycle low with some additional beta and return via some crypto related equities. So stay tuned for that if you're a level 3 member. And other than that, the only thing I want to point out is the bond market. This looks like breakout retest, possible resumption here, but it doesn't fit my idea. My idea is that this is going to roll over. I think this is just a short-term capitulation type move here in bonds, and the yields will ultimately resolve to the downside, which should actually provide more easing to the market than the Fed could ever dream of. So we'll see about that. We're also in that neighborhood now to finally start to get a daily and a weekly cycle low form for the dollar. This weekly cycle low is actually extremely late. So cycles can occasionally extend and take a bit longer to bottom. This one here is running about a daily cycle and a half overdue. So I would expect this turn to come soon, and I would expect this counter trend bounce at least to be quite violent. And then the question is, does this thing continue to squeeze to new highs, or have we got some kind of counter trend bounce here that resolves to new lows? We will figure that out one day at a time as always, but one thing I do know for sure is this cycle for the Dixie is extremely overdue, which is also true of Bitcoins, by the way. So that's pretty interesting. Historically, they are inversely correlated. That's not what we've been seeing over the past several months. So we'll be interested to see if both are going to run together, or if we're going to finally get back to having an inversely correlated Bitcoin and dollar relationship. So in summation, I stand with this base case hypothesis. I still think the thing is playing out more or less as expected. I know there are some points of contention in there, such as how can you be calling for new Bitcoin highs whilst the stock market makes a lower high? And look, I don't really know. I can't really reconcile it, to be completely honest with you. But crazier things have happened. If we'd have gone back a bunch of months and said that the dollar and the Bitcoin charts were going to be one-to-one correlated for a bunch of months, I don't think anyone would have believed that either. If we'd gone back several years ago when I was first making this call and I was saying that gold would run up with the dollar, with Bitcoin, with the stocks, I don't think anyone would have believed that either, because gold typically tends to trade inverse to risk. If we go back just several months, me saying that inflation was going to continue a disinflationary trend, that got all kinds of pushback. People were showing that silly fractal from the 70s. This one right here, everyone was telling me I was crazy for calling for disinflation and that the market only had one possible direction to move, and that was with inflation ripping to new highs as per this fractal. So again, I think crazier things have happened, and I continue to adopt this stance of I'm going to let the charts guide me, I'm going to remain open to all possible outcomes, and I'm going to continue to take this thing one day at a time. So if you're a level 3 member, look out for the members only video that's going to come for you guys. For everyone else, I hope you have a fantastic weekend, and I'll be back on Monday as always. Till next time, God bless, take care, cheers, bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel